Welcome back to the Deep Dive. Today we're going to zoom in, not on the huge corporations, but really on the backbone small businesses and also those mission-driven organizations, the not-for-profits. Our goal today, looking at the material, is really to nail down the particular considerations needed when you're auditing these specific kinds of entities. We're kind of trying to build a map, visually almost, of how auditors need to, well, basically toss out the standard playbook and customize things.
That's exactly right. Yeah, audits are never just, one size fits all. Our objective here is to really isolate those key factors, the structural stuff, financial quirks, organizational bits that fundamentally change how an audit works in these, let's say, resource-strapped or mission-focused places. If we don't get these specific risks identified up front, then, well, the whole audit strategy is kind of built on shaky ground, isn't it?
Okay, right. Let's unpack that then. Starting right at the foundation. What are the unique characteristics of these small businesses that just completely change the risk picture? What makes them different enough that an auditor has to think differently from the get-go?
Yeah, we can really break down the challenge of auditing a small business into, I'd said, 3 specific things, and they're intertwined. First, it's simply small size, just their scale. This affects everything, the number of transactions, how complex things are. They just don't have multiple layers of management or like super sophisticated IT systems, and that inherently limits the kinds of controls you might expect to see. The second thing, and this is probably the biggest risk factor, especially thinking about potential fraud, is limited segregation of duties. In a big company, controls are sort of built into the system. One person requests a purchase, someone else approves it, another records it, maybe a fourth person pays the bill. But when you have one person, maybe two, doing the authorizing, the recording, holding the assets, and doing the reconciliation, well, all those built-in checks just evaporate.
Ah, right. That's the classic setup, isn't it? Where the person running the till is maybe also the one checking the bank statements later. The controls basically boil down to trust, not systems.
Exactly. Yeah, precisely. And that flows directly into the third characteristic. Domination by management or owner. This one's really critical because when you have a single owner, or maybe a small family group, running the show with really strong, often informal control, well, it creates this inherent risk that management can just override any controls that do exist. They can sidestep written policies whenever they want because ultimately they're the boss. This weakness is there even if they have tried to put some formal controls in place.
Okay, so if we take those 3 small size, weak segregation, owner in charge, as just the reality on the ground, how does knowing that shape the very first step, the engagement itself?
Yeah.
How do you set the rules when you walk in knowing it's potentially high risk, maybe dominated by one person?
Right. That initial engagement part, it becomes strategically much more important. You have to be incredibly careful about defining the scope exactly because the risks are higher. We usually focus on 2 key things here. First, the pre-engagement stuff needs to be thorough. The auditor isn't just checking if they can do the job, they're really assessing if the client relationship itself is, well, viable. Is there integrity there? If a potential client pushes back hard on formalizing basic expectations, that's a huge red flag right away, before you even start the real work.
And I guess because that relationship might be quite personal, maybe built on trust, because of that owner dominance, getting it down in writing becomes even more vital.
Absolutely. Yeah, totally critical. And that leads straight to the second point. The need for and the detail within the engagement letter. This document, it's kind of your shield, right? In a place where informal control and maybe fuzzy responsibilities are normal, this letter clearly, legally, lays out the audit scope, what the auditor is responsible for, and crucially, what management is responsible for regarding the financial statements. It stops that mission creep and makes it crystal clear that while you're giving an opinion, the numbers themselves belong to the owner or management.
That makes a lot of sense. You've got to draw that line between being an advisor and being the auditor, like immediately. Okay, so moving past the planning, this awareness of inherent weaknesses, it must fundamentally change the actual audit work, right? How does the standard audit approach have to bend?
Yeah, this is where the real customization happens. The auditor needs to adjust their approach in, let's say, 5 main ways. Let's start with risk assessment. Given that limited segregation of duties and the owner dominance we talked about, the auditor generally just cannot assess internal control risk as low. It almost forces an immediate conclusion. The assessed risk of material misstatement is likely high. And that conclusion then drives the whole rest of the audit plan.
So you walk in basically knowing you can't really trust the internal system to catch mistakes. You sort of jump straight to the highest level of caution?
Pretty much, yeah. Which leads directly to the second point, which is about internal controls. Because of that inherent weakness, not enough staff, the risk of override auditors often spend very little, maybe even no time, actually testing the controls.
Why bother, right?
Exactly why test controls you already suspect or know are ineffective. It's just not a good use of time or money for the audit firm or the client. So this decision not to rely on controls forces a shift in where the effort goes, and that's the third point. A much, much greater reliance on substantive procedures. If you can't rely on the internal controls, you have to make up for it by doing more direct testing of the account balances and the transaction details themselves. You expand the scope, maybe change the timing, definitely the nature of those tests.
Okay, wait a minute. Let me just push back on that slightly. If these small businesses are often very cost sensitive, and you're saying the auditor has to skip the potentially more efficient route testing controls and jump straight to the really labor-intensive work, the substantive testing, doesn't that risk making the audit incredibly expensive, maybe even unaffordable for the very clients who need it?
That is the fundamental tension in small entity auditing.
That's a great point. Auditors absolutely have to manage that cost-benefit tightrope. The answer isn't just to test everything under the sun. It's often about using substantive analytical procedures more cleverly, more effectively. So, for instance, instead of vouching every single travel expense, maybe you analyze travel costs month over month, compare them to last year or to budget, and look for spikes or weird patterns. You have to use targeted, high-impact substantive tests, not just brute force volume. Okay, the fourth big adjustment deals with a classic risk in small companies: completeness. For big public companies, the worry is often about overstating assets or revenue to look better. For a small owner-run business, the risk often flips. The auditor's biggest headache can be making sure all the transactions, especially cash sales, actually got recorded in the first place. The owner might be tempted to manage some sales off the books, so to speak. How on earth do you audit something that might not even be there? That feels like searching for, I don't know, an invisible needle.
It forces you to get creative, yeah. You have to shift your focus sometimes from the internal books to looking at external clues or indicators. We use analytical procedures here too. We might test completeness by, say, comparing how much inventory seems to have moved with industry averages for that type of business. Or you could compare something like utility usage, electricity, water to the recorded sales. Does the level of activity seem to match the revenue being reported? If, tons of raw materials are being used, but sales look flat, that's a red flag. Maybe some sales aren't being recorded. And then finally, number 5. Because the information often flows through or is controlled by just one or two people, getting formal written representations from management or the owner is absolutely crucial. This isn't just a standard form. It's about formally pinning down the owner's legal responsibility, getting them to state in writing that they've given you all the relevant information and that they take responsibility for the financial statements being fair. It's especially vital when the whole control environment rests so heavily on one person's integrity and judgment.
Wow,
Yeah.
okay. That's a lot of tailoring. It really sounds like the auditor needs to be part detective, part economist when dealing with small businesses. Right, and let's make that shift we plan. Let's pivot to the second part of this deep dive. The not-for-profit sector, NFPs. What different considerations come up when the main driver isn't profit, but mission?
Yeah, auditing NFPs is definitely a specialized area. Their whole accountability structure is just different. They're generally focused on being good stewards of the resources they get and making sure they comply with what donors wanted rather than, making money for shareholders. So we need to think about this in maybe 3 related buckets. First, just understanding the specific characteristics of NFPs. This covers tricky stuff like how they recognize revenue, especially for grants and donations. Is a donation restricted for a specific purpose, or can they use it for anything? How do you handle permanent endowments? And what about non-cash stuff, like donated legal services or maybe donated goods for a thrift store? Accounting for those requires judgment calls you just don't see in a typical for-profit audit.
So you're not just checking the cash flow. You're essentially auditing compliance with the contract, the donor's specific instructions.
Exactly. Yeah, that's a great way to put it. And that leads into the second area, thinking about the types of organization within the NFP world itself. I mean, auditing a small local food bank, which might have really simple finances, is going to be worlds apart from auditing, say, a major private university or a large hospital system. Their funding streams are different, the regulations they face, maybe specific state attorney general rules, and the reporting frameworks they use can all be highly specialized depending on the type of NFP. And third, there are unique audit techniques you need. Because so much NFP revenue often comes from grants and government contracts. The audit often has a really heavy focus on compliance testing, making absolutely sure that money was spent exactly how the grant said it should be. You have to verify how they allocate expenses between different functions, making sure there's a clear line between program costs, like actually running the soup kitchen, versus fundraising costs or general admin overhead. Donors look really closely at that functional expense breakdown to see how efficiently the NFP is using their money.
It sounds like, really, for both small businesses and NFPs, the auditor's main goal, providing assurance, stays the same. But the actual roadmap to get there is completely unique depending on how the client is set up.
Yeah.
You can't just assume a revenue cycle works like standard sales. You have to dig into where the money comes from and what rules govern its use.
Absolutely, yeah. The audit strategy is totally tied to the entity's basic purpose and structure. It demands professional skepticism, sure, but applied to these unique goals, whether that goal is minimizing tax for a small business or maximizing donor compliance for an NFP.
Okay, so let's try to wrap this up. What does it all mean? We've kind of mapped out 4 really key areas needing special auditor focus. The built-in risk profile you find in small entity characteristics, the absolute importance of nailing down the engagement terms up front, the necessary tailoring of the audit approach, especially more substantive work and that focus on completeness, and then the specialized compliance work needed for not-for-profits. It feels like the whole conversation keeps circling back to recognizing inherent risk, especially that limited segregation of duties, and then building a custom audit plan around that reality.
Yeah, I think if you connect it to the bigger picture, this whole framework just shows that auditors um, they can't just rely on standard checklists. They need to be professional risk strategists, really. They have to constantly adapt their tests and often make them tougher based on the client's fundamental nature and, frankly, their structural weak spots. They can't just assume standard controls are operating effectively.
Right. And on that note, here's maybe a final thought for you, the listener, to chew on. Thinking about that domination by management or owner point in small businesses, how much does the purely human element, that internal tug-of-war for the auditor, between needing professional skepticism, but also needing to practically work with and trust a single owner who holds all the keys play, how much does that factor, that tightrope walk between trust and doubt, end up playing maybe the biggest role in their final decisions, especially when they know controls are weak and the owner is their main source of info? Something to think about. Thanks for joining us for this deep dive.